Vivek, we have 100 people with us. We can start.
Yeah. Thanks, Anand. Hi, everyone. Good evening. Our sincere apologies for being late on the call. We welcome everyone to InfoEdge Q4 and full year financial year 23 results conference call. As a reminder, all participant lines will be on listen-only mode, and there'll be an opportunity for you to ask questions after the presentation concludes. Should you need any assistance during the call, please raise your hand on the screen. Please note that this call is being recorded. From the management side, we have Mr. Sanjeev Bikhchandani, founder and vice chairman, Mr. Hitesh Oberoi, co-promoter and managing director, and Mr. Chintan Thakkar, our CFO. Before we begin today, I would like to remind you that some of the statements made in today's conference call may be forward-looking in nature and may involve some risk and uncertainties. Kindly refer to slide number 2 of investor presentation for detailed disclaimer. I would like to hand over the call to Mr. Hitesh for his opening remarks. Thanks, and over to you, Hitesh.
Thank you, Vivek, and apologies once again for starting a little late. Good evening, everyone, and welcome to our fourth quarter and full year earnings call. We will start with an update on standalone financials and then cover the financials of each business in more detail. The audited financial statements and other schedules on segmental billing, revenues, etc., along with our data sheet, have been uploaded on our website, infoedge.in. Overall billings in Q4 stood at rupees 748.6 crores, a year-on-year growth of 15.3%. For FY23, billings stood at rupees 2,366.3 crores, a year-on-year growth of 26.8%. Revenue in Q4 stood at rupees 564 crores, a year-on-year growth of 23.8%. For FY23, revenue stood at rupees 2,158.6 crores, a year-on-year growth of 38.2%. Billing and revenues along with acquired businesses Zwayam and DoSelect for the quarter stood at rupees 770.4 crores and rupees 586 crores respectively. For FY23, billing with acquired businesses stood at rupees 2433.4 crores, a year-on-year growth of 28.7%. Operating expenses for the quarter, excluding depreciation and amortization, were rupees 343.7 crores, a year-on-year growth of 5%. For FY23, operating expenses were rupees 1,374.4 crores, a year-on-year growth of 25.1%. Operating EBITDA for the quarter stood at rupees 220.3 crores versus rupees 128 crores reported last year, a year-on-year growth of 72%. And for FY23, operating EBITDA grew 69% year-on-year to rupees 784 crores from rupees 464.3 crores last year. Operating EBITDA margins for the quarter stood at 39.1% compared to last year, when the margins were compared to last year. For FY23, EBITDA margins stood at 36.3% compared to 29.7% for last year. Operating EBITDA, including acquired businesses, stood at rupees 231.6 crores, a year-on-year growth of 70.9%. For FY23, operating EBITDA, including acquired businesses, stood at rupees 807 crores, a year-on-year growth of 73.3%. During the quarter, we impaired an amount of rupees 12 crores granted as ICD to 4B Network Limited. Cash generation from operations for the quarter stood at rupees 412.9 crores compared to rupees 374.3 crores in Q4 FY22, a year-on-year growth of 10%. For FY23, cash generated from operations stood at rupees 1,038.5 crores, a year-on-year growth of 14.5%. Deferred sales revenue stood at rupees 1,018.5 crores as of 31st March 2023 versus 819.6 crores as of 31st March 2022, a year-on-year growth of 24.3%. The cash balance of InfoEdge, including the wholly owned subsidiaries, stands at rupees 3,490 crores as of 31st March 23. In the recruitment market, we are witnessing a period of cautious spending from customers in IT. The Q4 JobsSpeak reported a nominal growth of 1%, primarily due to degrowth in the IT space. On the other hand, positive hiring patterns emerged in sectors like BFSI, real estate, auto ancillary, travel, and hospitality segments during the quarter. The Indian real estate market continues to be stable, and certain micro markets are very, very hot. Though the price increases have stabilized in the last quarter, the inventory levels are still lowest in the last decade, and we're expecting a series of new launches in both the residential and commercial space. In the education space, we are seeing stability return to colleges and universities, and the number of students going overseas for education also continues to go up. Moving on to the financials of the recruitment business. In Q4 of 23, the recruitment segment billings were rupees 583.5 crores, a year-on-year growth of 13.7%, while revenues were rupees 437.6 crores, a year-on-year growth of 27.1%. For FY23, billings stood at rupees 1,858.7 crores, a year-on-year growth of 29.54%, while revenues stood at 1,679.6 crores, a year-on-year growth of 45.5%. Operating EBITDA for the recruitment business stood at rupees 271.5 crores, a year-on-year growth of 31.3%, and margins stood at 62.1% against 60.1% in Q4 of last year. For FY23, operating EBITDA stood at 1,030.9 crores, a year-on-year growth of 51.6%, and operating EBITDA margin was 61.4%, up from 58.9% last year. Cash generated from operations for the recruitment business during the quarter stood at rupees 447.3 crores, up from rupees 412.1 crore in Q4 of last year. The business generated 1,245 crores of cash from operations in the recruitment business, generated 1,245 crores of cash from operations in FY23, a year-on-year growth of 21.8%. Billings for Naukri India corporate business for the quarter stood at rupees 494.3 crores, a year-on-year growth of 12.4%, while revenues for the quarter from Naukri India corporate business stood at 367.8 crores, a year-on-year growth of 27.3%. Billings for Naukri India for FY23 stood at 1,567.2 crores, a year-on-year growth of 31%. Recruitment segment billing, including acquired businesses for the quarter, stood at rupees 605.3 crores, a year-on-year growth of 14.3%. For FY23, recruitment segment billing with acquired businesses stood at rupees 1,925.8 crores, a year-on-year growth of 31.7%. The quarter witnessed a strong sales effort with judicious use of discount reduction and price increases. Growth drivers in non-IT sectors helped drive billing growth in this quarter and are likely to continue the growth momentum. Global concerns impacting prospects of clients in the IT service are likely to impact prospects of clients in the IT services companies in India, but we're optimistic of hiring by captives and global GCCs. The Naukri site got around 20,000 new CVs per day, new registrations per day during the quarter, year-on-year growth of 2%. Daily active user count is up 10% year-on-year as well. We increased our marketing spend by 150% during the year with the view to enhance our brand salience amongst existing users and focus on increasing reach of our digital-led engagement and social media campaigns targeting the Gen Z audience. Traffic on Ambition Box also continued to grow at a healthy rate during the year. Moving on to the 99acres business, billings in Q4 in 99acres grew 30.8% year-on-year and stood at rupees 103.7 crores, while revenue grew from rupees 61.3 crores in Q4 to rupees of 22 to rupees 75.5 crores in Q4 of 23, a year-on-year growth of 23.1%. For FY23, billings stood at rupees 311.6 crores, a year-on-year growth of 35%, while revenues stood at rupees 284.5 crores, a year-on-year growth of 31%. The operating loss for the quarter for 99acres stood at rupees 19.1 crores, as against a loss of rupees 33.8 crores in Q4 of last year. For full year 23, operating loss stood at rupees 107 crores against a loss of rupees 78 crores last year. In Q4, the 99acres business reported a cash inflow from operations of rupees 13.5 crores for the quarter, against an inflow of rupees 3.6 crores in the same quarter of last year. For the full year, the business reported a cash outflow of rupees 72.2 crores. The 99acres business witnessed a broad-based growth across all categories in this vertical: resale, rental, commercial, and new homes. A healthy demand environment increased traffic on the platform, and multiple initiatives by the business teams to improve content quality led to significant increase in inquiries and leads on the platform for our clients. A stronger sales rigor and comprehensive go-to-market to cater to launch marketing stages was the key highlight of the quarter. We will continue to invest in platform content, client delivery, and marketing in the months to come. Moving on to the education business. In Q4, in Shiksha, billing stood at rupees 40.9 crores, a year-on-year growth of 42.4%, while revenue stood at rupees 32 crores, a year-on-year YoY growth of 31.1%. For FY23, billing stood at rupees 123.9 crores, a year-on-year growth of 28.4%, while revenue stood at rupees 116.9 crores, a year-on-year growth of 29%. The business made an EBITDA of rupees 2.3 crores in the quarter, against an EBITDA of rupees 4.8 crores in Q4 of last year. For full year 23, EBITDA stood at rupees 7.8 crores, down from rupees 19.5 crores reported last year. Cash inflow from operations for the quarter in the Shiksha business stood at rupees 15 crores, against an inflow of rupees 10.2 crores in Q4 of last year. For full year 23, cash inflow from operations stood at rupees 21.1 crores. The rebound in the Shiksha domestic business helped drive growth for this quarter. With many more sort of private universities and colleges in India being established, we expect this growth pattern to continue. Moving on to the 𝐒𝐮𝐩𝐽𝐶 business. Billings in Q4 in 𝐒𝐮𝐻𝐶 declined by 27% year-on-year to rupees 20.5 crores, and revenue declined by 26% year-on-year to rupees 18.8 crores. For FY23, billings stood at rupees 72.1 crores, a year-on-year decline of 29%, while revenue stood at 77.6 crores, a year-on-year decline of 22.5%. The operating EBITDA losses for the quarter stood at rupees 21.9 crores for the quarter, against a loss of rupees 38.8 crores in Q4 of last year. Operating loss for FY23 stood at rupees 101.4 crores, against an operating loss of 120.4 crores reported last year. Cash outflow from operations for the quarter stood at rupees 19.4 crores, against an outflow of rupees 29.3 crores in Q4 of last year. Cash outflow for FY23 stood at rupees 126.2 crores. The free chat model in 𝐒𝐮𝐻𝐶 continues to drive profile growth and engagement on the platform. New paid products launched in December resulted in some sequential sales growth. The team continues to explore ways and means to monetize the increase in traffic on the platform. In continuing with our stated strategy, we are reducing our advertising and promotion spends during the quarter. We continue to reduce our advertising and promotion spends during the quarter. The spend was down, advertising spends were down 51% year-on-year and 6.6% sequentially. Moving on to the consolidated financials. At the consolidated levels, the net sales of the company stood at rupees 604.8 crores versus rupees 472.9 crores in Q4 of last year. For the consolidated entity, at the total comprehensive income level, there is a loss of rupees 414.8 crores versus a loss of rupees 6,420 crores for the corresponding previous last year. And adjusted for the exceptional items, PBT stood at a loss of rupees 349.5 crores in Q4 versus a profit of rupees 285.7 crores in Q4 of last year. Thank you. That's all from us, and we are now happy to take questions.
Thanks, 𝐿esh. We'll now begin Q&A session. Anyone who wishes to ask question, may raise your hand. We'll take your name and announce your turn in the question queue. We'll wait for the question queue to build up.
Thanks, Vivek. Thanks, Hitesh. So first question is from Vivekanand, Ambit Capital. Vivek, go ahead and ask your question.
Hello, thank you so much for the opportunity. I have two questions. The first one being on the recruitment business. So, Hitesh, in your opening comments, you mentioned that there is obviously some pain or perhaps caution as far as IT companies are concerned. So, heading into FY24, how are you thinking about the billing trends, given that JobSpeak has been fairly muted year to date? That's question one. Secondly, on 99acres, thanks for the opening comments. So it's clear that all segments of the markets are growing. So my question here is the market growing much faster than what we reported as results, given that we have slipped on traffic when I look at similar web data? And if you could give us some sense on what you are doing to mitigate this decline in traffic, or am I looking at it wrongly? Thank you.
Yeah, so to answer your first question, IT hiring. So we expect IT hiring to continue to be slow for at least a couple of quarters. IT hiring, IT jobs on the platform moved into negative territory some time back. And we, from what we are sort of seeing around us, what we hear from our customers, we don't expect, we expect things to continue to be like they are for some more time. Of course, a lot will depend on what happens to the US economy. And in the past, what we've seen is every time there's been a slowdown, while Indian IT companies do get hit for a few quarters, but after that, you always see a sharp bounce back because more and more jobs are outsourced to India. Because if companies want to cut costs in the US, they end up outsourcing more jobs to India over time. Whether that will happen this time around or not is hard to say. But yeah, I mean, IT companies are sort of slow right now when it comes to hiring. The non-IT market continues to be rock solid. Many sectors are doing very well. Sectors like BFSI, sectors like travel, retail, hospitality, sectors like auto ancillary, sectors like construction, real estate. These sectors are sort of growing well, and they continue to hire a lot of people. So could there be a further slowdown in IT hiring over the next few months? Possible. 99acres, see, we don't think we've lost share in, we haven't seen a reduction in traffic. In fact, our traffic has grown over time. We've done a lot of changes, made a lot of changes to the platform, which has resulted in the platform generating many more inquiries and many more leads for our clients than was the case earlier. And that's reflecting in our numbers as well. Q4, billing growth was 31%. Full year billing growth was 35%. The business generated cash actually in Q4. We made a 13 crore cash profit in 99acres in Q4. And this has happened despite us, reducing marketing spends in Q4 and despite heightened competitive activity as well. So it's not as if competition is not spending a lot of money. Some of our competitors are very aggressive in the market. Are we growing at faster than the market? Well, the market, some real estate markets are doing well. Real estate is very sort of local. And there's a lot of, for example, real estate is doing really well in Gurgaon and Noida, but maybe not in many parts of Delhi. So real estate is very local. So some hotspots are doing very well. And because there were very few launches during COVID, the amount of unsold inventory in the market has gone down, which has which is leading to higher prices. So a lot of the growth that we are seeing in real estate is price driven. While we didn't really aggressively take up prices last year, our growth is mostly volume driven in 99acres.
Okay, this is helpful. Just one clarification on the outlook as far as IT hiring and your monetization is concerned. So understand that IT hiring, there could be more slowdown, but are you taking any initiatives maybe on the product side or on the pricing side or any other such initiative that is helping you perhaps buck the trend as far as your billing trends versus say perhaps the headcount addition by IT services companies?
See, there's little that we can do on IT hiring right now because hiring has slowed down. So, of course, we are trying to sell more and more new products to our customers. But what we are working on actually a little more right now is the non-IT side, because that's where the opportunity is. So we are fine-tuning our product offering for non-IT customers because they are still hiring and they are hiring in large numbers and there is scope to monetize them better. So that's likely to be the focus for the next few months. On the IT hiring side, it's a wait and watch game. We of course continue to work on our product. We continue to improve our platform. We continue to invest in some of the long-term projects that we've been pursuing. But it's unlikely that we can do anything in the short term which will move the needle on IT monetization for us.
Okay, thank you and all the best.
Thanks.
Thanks, Vivek. Next question is from Abhishek Bhandari from Nomura. Abhishek, go ahead and ask your question.
Yeah, thank you. Hitesh Chintan. Despite sounding cautious on IT hiring for last 2-3 quarters consistently, we have been able to do a billing growth in double digit. And given the momentum X of IT, do you think we could still look at these kind of numbers, notwithstanding the problem what we're seeing in IT, at least in FY24?
See, 50% of our billing comes from non-IT, and about 50% is IT at a very macro level. Now, if the non-IT, if the economy does well, if the economy starts to grow at 6-7% per annum, for example, the non-IT hiring piece could grow at 25-30% per annum, right? On the other hand, if the economy were to slow down, then even non-IT hiring could take a hit. IT hiring, has been very, very slow for about 3-4-5 months now, and could continue to be slow for the next 3-4-5 months. We don't know when the IT hiring market will turn, and have we hit the bottom? I don't know, right? We will know only in a couple of months. So we are hoping and banking on the fact that IT hiring will turn around by H2 sometime, and the non-IT market will continue to be solid. And if the non-IT market continues to be solid, and if IT hiring turns around in the second half of this year, then we may still end up with growth, with Naukri growing in the teens somewhere. But if IT hiring were to slow down further, and the economy were to also sort of move sideways, then it could be a challenge.
Got it. That's helpful, Hitesh. Hitesh, my second and last question is, any thinking around now lifting the dividend payout for the shareholders? We are generating such a handsome amount of cash from our, core business. The business does not need too much of investments. We have, almost 3,500 crore cash lying. But yet, our dividend payouts are like very, very low. You're just paying 9 rupees in Q4. So do you think you would want to increase the payout ratios, from the current level?
Chintan, you want to take that?
Sure. So this 9 rupees, first of all, it's more as a factual clarification. This 9 rupees is the final dividend. We already gave 10 rupees as an interim dividend as well. So it's 19 rupees, overall. But I understand, the overall question that, look, it's in comparison to the amount of cash that we have, this may look, small, Our policy, if you look at dividend policy, which is there on our website as well, that we usually distribute certain portion of cash PAT, and that's what we have done. So if you look at it this year, it's like 35% of PAT. So it's like 1/3 of the cash that we earn, we have kind of at a high level, it's that what we have given, right? Now, is there's a case for any special dividend? I think that's a very separate consideration. We still think that there could be an opportunity for us to invest in this money. In investing, and we continue to look for good opportunities for the same. So right now, we would like to hold on to the same, but should an opportunity arise, should that occasion arise where we think that this cash is in excess of what we think we require, certainly, we can look at special dividend or buyback or something. But right now, there is no thinking on those lines.
Yeah, may I add to that? Sanjeev here. So look, I think we have customer advances. That money doesn't belong to us. What is the amount of customer advances we have, Chintan, right now?
Should be around 800. I could be wrong, but I'm just
30th, it was around 1,100 crores.
1,100 crores. So that is not our money, right? So that is bank. And tomorrow, in case customers ask for it back, if something goes wrong and they have to give it back, that goes back to customers. So you remove 1,100 crores from 3,400, 3,500, you're left with 2,300 crores, right? You want to keep some rainy day money. You want to keep some money for acquisitions. You want to keep some money, in case there's a serious downturn and cash goes down, cash surpluses go down, right? So it's not that much money, but I'll give you a couple of examples of situations where this seemingly high cash balance has helped us. The most latest one being COVID. So in March 24th, 2000, there was a lockdown enforced by the government of India. April, June 2000, Naukri billing growth, I think, was -44%. There was no clue. Nobody had a clue as to what was going to happen, how long the lockdown will continue, how severe the pandemic was going to be. Is there a vaccine? Is there a cure? What was going to happen to hospital capacity? And everybody was at home, right? At that time, we asked Chintan, and we gave him a simple sort of thing to solve, which is, okay, assuming sales revenue goes to zero and marketing expenditure goes to zero and increments go to zero, how long can we run on the current cash balance? And he came back with the answer of 3 years, right? And that emboldened us to take a call that we will not sack anybody, right? There are very few companies in the digital space that did not sack people in India, right? We were one of them. And no, it is, in our opinion, at a time like when the pandemic had just begun, people were anyway tense about their own lives and their health. That if you start downsizing them and they won't get a job for many months, it'll get very, very tense for them. And we can't do that because this company has been built by people. And we were able to take that call simply because we had this cash balance, right? So, and this has happened earlier as well. When Lehman went down, we had the cash balance to not sack people, right? And so therefore, I personally believe that this is the right thing to do, and therefore we do it.
Got it. Thank you for the detailed answer, Sanjeev, Hitesh, and Chintan, and all the best for next year.
Thanks, Abhishek. Next question is from Pradyut Ganesh from ICICI. Pradyut, go ahead and ask your question.
Yeah, hi, this is Abhishek here. So, on the 𝐒𝐮𝐩𝐸 business, right, there has been a lot of competitive action there. If you could give us some clarity on how the competitive landscape is looking there, and what is your outlook on monetization going forward?
In 𝐒𝐮𝐩𝐸?
Yes, 𝐒𝐮𝐩𝐸.
Well, it's a very hotly contested market. So, we have two big players in that market, Shaadi and Bharat Matrimony, and they've been spending a ton of money on marketing. The pricing has also been very aggressive. So we changed our strategy a while back. We moved to a freemium model. We made chat free on the platform. So some of the stuff we are charging for earlier is now free. And in line with that strategy, we've also fine-tuned our marketing sort of strategy. We are not spending as much money on marketing as earlier because the proposition in itself is helping us acquire users cheaper, the new proposition. So that's been our approach. So we've brought down our marketing spend substantially in the last 2 quarters. And despite that, our user growth is solid and there's a lot of engagement, and we are enabling many more matches on the platform than earlier. Now, of course, this strategy has also resulted in our revenue crashing. Our revenue is down 27% year on year. And now the team is sort of working on, ways and means to monetize better. Now that is still work in process, still early stages of that. So we don't know how things will pan out. But traffic growth is healthy. Engagement is healthy. There's much more matchmaking happening than earlier. We have cut marketing spend and it still seems to be okay. Okay. I don't know how competition will react going forward. And at the same time, we're also seeing a lot more activity in the dating sort of space, right? So there are lots of players who are active in that space. But that's not a market which 𝐒𝐮𝐻𝐸 competes in. But we are, of course, seeing a lot more activity in that market as well compared to earlier.
Understood. So in terms of market shares, would you say that you have gained share? I mean, how is your position vis-a-vis, say, 1 year back?
See, we have lost revenue share, okay, but we have gained traffic share. We've gained share of user share over, compare vis-a-vis Shaadi, for example, in the north and west, which is where we are sort of mostly present. And we have, of course, cut burn.
Got it. And so would you give us some flavor of what you are thinking about in terms of investment opportunities? What kind of businesses you are looking at? Whether it is B2C or B2B, because B2B has suddenly become a very hot space. So would like to hear your thought process on what would be the best investment opportunities that you are trying to assess.
Financial or strategic? Which ones are you?
Financial, yes.
Financial. Okay. Sanjeev, you want to take that?
Yes. Sorry, could you repeat that?
Which spaces are we looking at for financial?
No, look, so in financial investment, we look at every sort of tech space other than jobs and careers, education classifieds, and matrimony and dating, okay, and real estate. Right. Other than that, all is open in the tech space. So we've done a whole wide range. We typically don't do it top down. We do it bottom up. We assess about 1,000 startups a quarter, either through meetings or through, or on phone calls, or even just looking at the decks that come to us. And then maybe we invest in a few. So it's bottom up, good founders chasing good ideas or seemingly good ideas, we might go in.
Understood. Thank you so much, sir.
Thanks, Pradip. Next question is from Ankur Rudra from JP Morgan. Ankur, go ahead and ask your question.
Hi, good evening. Thanks for taking my question. So the first one is on IT. Did you say that the mix is still 50% IT versus non-IT on a billing basis?
Approximately.
Okay. So given the difference in growth rates and the difference in how the growth is trending out, do you think that the balance of growth, whatever you see, the weakness in IT will be more than made up by the strong momentum you're seeing at the moment in non-IT over the course of this year?
It'll depend on how much the Indian economy grows at going forward, and it'll depend on when IT recovers. So right now it looks okay, because the non-IT companies are doing well. And of course, if the Indian economy starts growing faster, then they may do even better. In the past, we've seen that when growth starts to hit 6-7%, domestic growth, it's possible to grow at 25-30%, at least in the non-IT space. As far as the IT hiring piece goes, a lot will depend on when IT starts to recover. So, and how bad the slowdown is, right? Have we hit rock bottom? I don't know. Okay. Will things get better from here on? I don't know. It's hard for me to predict at this stage.
Sure. Could you give some more color, Hitesh, on the IT billings trajectory? I think you said it hit negative on a billings basis a few months ago. Was that in the March quarter or is that in the current quarter?
In this, so it's been trending south for the last few months. The job index, I said, hit negative territory, has been in negative territory for the last at least 2-3-4 months now. I don't have the exact, it was minus 27% for software services. The job speak index we publish, right?
Right.
Which basically captures volume more than anything else. So in April, and it's not as if May is looking any better. So the IT hiring has been sort of very, very slow for at least 4-5 months, 6 months.
Of course. On a billing basis, could you give us a sense, how is IT billing growth momentum right now? And if that trajectory has gotten worse, because you've obviously seen 2 more months of the current quarter, how's that trending in the June versus the March quarter?
Very good. This way, it's not getting any better.
Okay. And is it already negative on a billings basis also, or is what we're seeing on JobSpeak, representative?
Chintan, did we give out that data? I mean,
it's hard for us, Marco, because we are in the quarter is still going on, and most of the billing also happens in the third, in the last month of the quarter. So it would probably be wrong, and also even if you have to give some estimate.
Okay, but you can clarify that it didn't hit negative on a billings basis, at least in the March quarter, right? IT part of the whole thing.
No, I think in we are talking about Q4. Yes, Q4. Yes, Q4. Yeah, so Q4, even Q3 in that sense, actually it was the growth rate was more reflected because of the non-IT rather than IT. So our original question, whether is non-IT growth will compensate for IT. So far, the trend has been that in Q3 as well as in Q4. Now, what Hitesh is saying is that will it happen? Will it remain the same in Q1 or not, I think we are yet to see, and we'll have to see till we complete the quarter and come out with the results.
No, I totally understand. I was wondering if you can share with us any color for if IT billings hit a negative trajectory for any of the months of the March quarter.
I don't have the exact number right now, but as I said that, look, I think it's the growth trajectory of non-IT was more than enough to compensate for the reduction in the IT.
Okay, maybe changing tracks a little bit. Fourth quarter has always been your strongest quarter, and many deals close. Has there been any increase in discounts given out this time, given the weakness in half your portfolio?
I'm sure. See, this is always the case. Yeah, whenever the market slows down, you end up giving more discount because that's the nature of the beast. So I'm sure that's happened in a lot of cases with a lot of clients in IT. That must have happened.
Is this something you're concerned about from a pricing perspective for the next year?
No, see, this is standard stuff. Yeah, this is what happens in every slowdown. And once the market starts to recover, then pricing will go back to normal.
Okay. Last question on this side. Do you think there's ability to sustain margins given where the momentum is right now?
So in Naukri, see, we continue to invest in many areas which are, we think, important for the long run. We are hoping that this slowdown will not last for more than a couple of quarters. So if we are able to grow billings at even 14-15% this year, then I don't think our margins will be impacted. On the other hand, if billing growth slows down and we start growing in low single digits, then of course margins will be impacted this year in Naukri, because we don't want to cut our investments in areas like data science and the blue collar job board we're working on, some of the other stuff that we're doing, which we think is strategic and important from a long-term standpoint. Can we maintain margins? If we want to, we can, but I don't think it's necessary at this stage. And we are hopeful and confident that hoping that the market will come back. IT hiring market will also come back by Q3 or Q4 of this year.
Okay. One question on 99 acres. Any changes in thought process about monetization besides the classified model that you've thought about over the last 1 year? I know you've written off 4B, but in general for 99 acres.
So see, we have the resale in the resale business, the rental market, we sort of have a classified model at work. But increasingly for some of the large customers in the new home sort of category, we run a lot of CPL, cost per lead campaigns. And so our billing is indexed to how many leads we are able to generate for them. And it's not just a listing fee which we charge them. So the business has slowly been moving in that direction as far as new homes, new home monetization goes. We currently follow this model with a lot of large clients.
And how big
would
this
customers we have the listing model.
Understood. How big would this be in terms of volumes or revenues, Hitesh? Could this be a significant part going forward?
It could be a significant part of the new home business going forward.
Okay, understood. Thank you and best of luck.
Thanks.
Thanks, Ankur. Next question is from Vijit Jain from Citi. Vijit, go ahead and ask your question.
Yeah, thank you, Anand. Hitesh, my question is just going back to the recruitment side. You mentioned earlier that in the non-IT side, you see scope to monetize better, and you also singled out certain sectors where you're seeing good growth. So I guess I'm just wondering, in the non-IT space, are all sectors looking similar broadly in terms of how you monetize them, or are you further ahead in certain sectors, still lagging in certain other sectors? If you can just throw more color on, non-IT segment wise, it'll be great.
So let me just rewind to about 15 years ago. 15 years ago, when infrastructure was hot, clutch of sectors like infrastructure, construction, real estate, heavy engineering, auto, these energy, these sectors together were almost 25-27% of our business. And till last year, these sectors were down. The revenue from these sort of segments was down to 14-15% of our business. So because these sectors didn't grow for a long time. After a long time, we're seeing a lot of action in real estate. We are seeing a lot of action in construction. We are seeing a lot of action in similar sectors, these sort of infra sectors. Now, if this action continues for a long time, then there is no reason why we should not be able to build a lot more from companies in these sort of spaces going forward. So that's one thing we are seeing in non-IT. The services piece continues to be solid. Banking, financial services, insurance companies, travel, hospitality, retail sectors which are impacted by COVID, they are bouncing back. So there's a lot more action in these sectors when it comes to hiring. We are seeing a slight slowdown in sectors like consumer durables, in sectors like fast-moving consumer goods, in sectors like healthcare and education, which were super hot till some time back. There's been a slight slowdown which we've seen in some of these sectors, in these sectors in the last few months. But by and large, the non-IT market continues to be strong. Hiring market continues to be strong. Now, at our end, our product works reasonably well for non-IT companies also. So a lot of companies hire salespeople, customer service professionals, finance professionals, HR professionals, marketing folks through Naukri. But there is an opportunity for us to sort of expand our business to more cities, for example. So right now we operate in about 40-45 cities. There's no reason why we can't take our business to over 100 cities in the next 2 or 3 years, right? If the markets are supportive, because we are seeing a lot more growth in small towns than earlier. Of course, it will not result in a lot of revenue in the short term, but long term, these can become interesting markets for us to operate in, and they are mostly all non-IT driven, services led, and so on. We are fine-tuning our search and recommendation engines so that they work better for non-IT hiring. A lot of our focus for the last few years or 2-3 years was on IT hiring, because that's where the IT hiring market was very hot. And but now that we are seeing a bigger opportunity in non-IT, we are going to work on fine-tuning our sort of search and recommendation engines to ensure that companies are able to hire more people through our platform in some of these segments as well. So that's just to sort of help you understand the nature. See, where we are seeing the biggest slowdown right now is in our recruitment consultants business, right? Because about 30% of our business comes from recruitment firms, and these recruitment firms hire a lot of them hire for IT companies, and they are the ones which are hit first, because they are in some ways the more expensive way to hire, and when companies cut sort of budgets, they are the ones who get impacted first, and therefore their spend on Naukri gets impacted as well. So that's just to give you a sense of how the market is panning out right now. I hope I was able to answer your question.
Yeah, Hitesh, that was super helpful. My second question is just on the 99 acres business, the property segment. You mentioned some of your competitors have been super aggressive, spending on marketing and everything. And in revenue terms as well, it does look like some of them, at least, especially say a housing.com, which REA has already disclosed numbers for, has grown faster than you guys. Is that something that is happening, you think, because there are more products on their end, which is still work in progress at your side, because you monetize a little bit differently? Do you think that is driving that difference, or is it something else?
Well, you have to sort of lift the veil. So we still believe that we are the largest in the space, and we are growing reasonably well. Q4 was great, and we think we are sort of in some sort of markets we have gained share. And we don't do a lot of stuff which other companies do. So we don't do any barters. We don't do combo deals with newspapers. We don't have any pass-through revenue through our platform. We don't, monetize other services. We sell only real estate advertising. So we don't make money from packers and movers. We don't make money from home loans. We don't make money from a lot of other ancillary services, which a lot of these companies do. We don't have any transaction revenue, which a lot of these companies have. So we are, relatively speaking, a purer play than some of our competitors. So it's important to compare apples to
Yeah.
apples.
Got it. Yeah, sure. Sure. Thanks, Hitesh. Those were my questions.
Thanks, Vijit. Next question is from Nikhil Chaudhary. He's from Nuvama. Nikhil, go ahead and ask your question.
Hey, hi, Hitesh. First question is regarding your comment on discount and pricing. You mentioned that you have cut some discount and there is some increase in pricing. So just wanted to understand how much of the billing growth basically came from this initiative and how much further tail room you have to increase it further going ahead.
See, it's unlikely that we will up pricing in IT, given that the IT hiring market is very slow. Where we may be able to realize more is in the non-IT sort of from our non-IT customers going forward, because they are hiring large numbers. So we'll have to, going forward, see, last year, first 6 months, we were very aggressive on pricing. A lot of our revenue growth was pricing led. Of course, there was a lot of volume growth as well because the market was really hot. But if you look, maybe in the second half, our growth was mostly pricing led and not so much volume led. Going forward this year, in non-IT, our growth is likely to be volume led to a large extent and also pricing led. But in IT, we are unlikely to see any growth because of either volume or pricing.
Sure. Second question, Hitesh, is on the impairment of 𝐒𝐻. Just if you can give color what happened in basically what led to the impairment, and one of the thing which is mentioned in the filing about unspecified buyback liability. So just a few.
Yeah, can I address that?
Sure.
So it's like you see in all our SHAs, we have a waterfall drag along clause. There are. So, in 3 years' time, you'll give an exit, or 5 years' time, you'll give an exit. The exit could be a listing, it could be a strategic sale, it could be a buyback. If you fail to do that, we have the right to impose a buyback, all the investors together. If you fail to honor that, then we can drag you along for a sale, right? You have standard clauses in VC investment agreements. All VCs do it. Now, this clause, was construed to be a liability, not a contingent liability, right? Now, if there's a liability at FMV, I mean, the FMV of business is what it is given the last round of valuation. Then it was construed that the company may not have enough money to pay off the investors should they ask for the money, right? And therefore, we were forced to write it off. It's a technical write-off in my view. It does not reflect the business prospects of the company. But it has to be done for principle of conservatism, and that's what it is.
Sure, Sanjeev. Just one follow-up here. Do you see any possibility of such scenario happening in any other portfolio companies, any large portfolio companies?
I don't think so. There's nothing to announce here, but Chintan, any comment, observation there?
I think every case is a bit different because the agreement and the language of the agreement could be different. The investors' insistence on whether they want it or they can dilute this also is different. I'll tell you one of the big differences is that because we are listed entity, we are expected to follow NDAs, while some of the other PE and VC firms may not be under obligation to follow that. So that's why the certain standards that the auditors want to apply on how the assets are being valued, for us could be very different than what the standards that might get followed by some of the PE and VC firms. So like Sanjeev said that this is not a reflection on what their growth and what the potential or the business model of that company, but this is more arising because of how the shareholders agreement is being interpreted by the
let me explain. If this had been construed to be a contingent liability, there would be no problem. But because it was construed to be a liability and not a contingent liability, we had to write it off. That's a big difference.
Sure, Sanjeev. Thanks a lot, Hitesh, Chintan, Sanjeev, very helpful. Thank you.
Thanks, Nikhil. Next question we have from Ksenia Garg from Nivath Investment. Xenia, go ahead and ask your question.
Good evening all. Thank you for the opportunity. Sir, I just have one question, which is considering the current slowdown in the startup funding and the decline in valuations of many startups, what are your perspectives on when the startup funding pipeline is likely to be normalized?
So, do you want to take that?
Sorry, apologies, could you repeat that? I'm really sorry about that.
No problem, sir. So, like considering the current slowdown in the startup funding and there are many decline in valuations of many startups, what are your perspectives of the funding pipeline is likely to normalize?
Look, it's hard to predict, but in general, we are finding that there is still enough entrepreneurial activity. There are a lot of number of startups. It's actually a good time to invest. If you look back, if I look back, and our best investments, policy and 𝗗𝗘 were made in just around the global financial crisis, or just after it, or maybe just before it, right? These are actually good times to invest if you have a 7, 8, 10-year perspective, which is what we do have. So for us, actually, it's quite good.
Okay, sir. Thank you.
There's one question in the chat box for you, 𝐻𝐻. The question is from 𝗗𝗘𝗠𝗔𝗗𝐬𝐨. I'll read the question for you. How should we think the business will move going forward? Which business to drive growth going forward? What is your focused area in each of the business segment? And how should we think business growth in next 2 to 3 years?
So, I mean, see the business. I mean, the Naukri business has done really well for the last 2 years. I mean, I think we managed to almost triple our cash flows from operation. We've more than doubled our revenue in the last 2 years. We are seeing hopefully a temporary slowdown in IT hiring. Hopefully, the AI boom will actually end up creating more sort of opportunities for Indian IT services going forward. That's what's always happened with, at least in the past. And hopefully, India is part of the solution. If companies in the US want to cut costs, they'll end up outsourcing more and more jobs to India. And to me, it looks like infrastructure is back. Government is investing a lot of money in infrastructure, and that is also going to lead to a lot of job creation in the short term and in the medium term. And in general, the economy seems to be in good shape. It's perhaps in better shape than it was when we went into COVID. So if the economy continues to sort of do well and IT hiring bounces back, then and we are able to grow at 6-7% per annum, then the Naukri business can grow very, at a very healthy rate, at more than 20%. And it's a very high margin business. It's not as if we will have to invest a lot of money to get this growth, right? We already have offices, we already have salespeople, the platform is already built. Now, we've also been acquisitive for the last 3-4 years. We've acquired a few startups, and of course, it's also our plan is also to sort of grow these businesses that we acquired over time. Businesses like Zwayam, businesses like iimjobs, businesses like DoSelect. We are working. So hopefully these businesses will start scaling once we put the Naukri might behind them. And there are, of course, some more opportunities we've identified, which I don't want to talk about right now, which, like I mentioned, small towns. So we will expand into more and more cities going forward. We've invested in a platform, in a edtech platform, �CodingNinja, right? We own 51% of that company. And we intend to work closely with them to help them grow their business faster and to also improve our offering for candidates, for job seekers on Naukri. So there are a bunch of things we are working on as a platform, we will continue to invest behind these sort of initiatives. Some of them are short term, some are more medium term. We have been working on a blue collar job board for the last 3-4 years. We'll try and start monetizing this sort of product sometime this year. But this is more a long-term play. We don't expect any significant revenue from this business over the next 2-3 years. But long-term, we think it's a good bet, and it's important that we sort of have a foothold in this space. So these are some of the things we're doing in Naukri, which will hopefully drive growth going forward. Similarly, in 99acres, we've done well in the resale and rental categories. If you ask me, that part of the business has done quite well. Commercial part of the business has also done well. But we see a lot of opportunity in new home monetization. There are lots of new developments being constructed everywhere. There are lots of satellite towns emerging. Inventory is down of existing homes is down to an all-time low. There is a lot of interest in real estate once again from buyers and investors. Now we need to crack open this market. It's not a done deal. We are a very small part of this market. Over a few thousand crores are spent on new home marketing. We got to get a small fraction of that. So if we can somehow do a better job of executing in the new home space, then that can drive growth in 99acres for the next few years. Of course, if the team executes well, then of course there will also be an opportunity to gain more market share over time in 99acres, and that could again drive growth, even higher growth in 99acres going forward. In Shiksha, we are investing we have the domestic business, which is growing at 20-25% per annum. But about a few years ago, we had also entered the study abroad space. That is today a small business for us. But we sent over 1,500 kids overseas last year. This year, we are targeting to send more than 2,000 kids overseas. And if we get a good handle on this business, then this business can also become a large business over time. In 𝐒𝐮𝐩𝐸, we are working on the new model. And if we are able to get our act together on monetization, if you're able to cut burn, the 𝐒𝐮𝐸𝐸 business could sort of get to a decent place. And we also acquired a 76% stake in 𝐼L, which is a dating platform. Again, early days, but we are investing in that business. And if we see good traction, then we will double down on the dating category as well. So these are some of the areas where we are investing. All of them are work in process, but hopefully some will work out over the next 2 to 3 years for us.
The next question is from Vivek from Ambit Capital. Vivek, go ahead and ask your question.
Hello, thank you so much for the follow-up opportunity. How much of the committed AIF money has been deployed already? Sanjay, if you could give us an update on the 4 AIFs that we currently have.
Well, there's Fund 1 and the follow-on fund. That has been a significant chunk of that has been deployed. Fund 2 and Capital 2B, it's comparatively less because we've been going slow and careful, and there's still enough time left to do our first checks. We typically do not announce exact numbers on this.
Okay, and the reason why it's taking you longer to deploy in the Fund 2 and Capital 2B is because you have to scout for new names, is it?
No. So it's like this. Those are more recent funds. After the final close, typically we have, I think there's a rule, I think it's the final close, I'm not sure. We've got 3 years to write the first checks, right? We want to take our time and be very, very selective given the state of the market. We want to be particularly careful about valuation of the enterprise. We want to be particularly careful about going after capital efficient companies and entrepreneurs, given the tight funding environment. So we're taking our time. That's all. And yes, we do not invest from Fund 2 into Fund 1 companies or from Capital 2B into Fund 1 companies. Those are watertight compartments.
Okay. My last question is on the financial investments that sit on the balance sheet, not included in the AIFs. So yes. Did you make any major investments in the current fiscal year as follow-on rounds in, say, Ustraa or Shop Kirana?
We have done some. I'm not sure it's major, but we've done some. I mean, Chintan, can you?
I don't have the numbers right now, but yes, we would have made some follow-on rounds and some small investments even in companies like.
But the big tickets are done. The big tickets are done there.
Yeah, it's nothing major.
Okay, great. Thank you.
Thanks, Vivek. The next question is from Vijit Jain from Citi. Vijay, go ahead and ask your question. Yeah, Vijay, go ahead and ask your question.
Yeah, hi, thanks. Sanjeev, my question is to you. I guess if you look at what's been trending in the startup space in India and globally, more recently in India, it's ONDC specifically, I guess AI obviously globally. My question is, are you seeing any opportunities?
Yeah, what's the question?
Sorry, so my question is, are you seeing any opportunities in those two that you're excited about? Are these focus areas or any interest areas for you in terms of how you look to deploy?
Yeah, like I said, we do it bottom up, not top down. But yes, of course, some of the deals we have looked at and possibly even done have components of AI, machine learning, right? I mean, there are a number of people trying. We typically have now ONDC is so we don't do D2C. Typically in our fund, we prefer, we don't think that's central to our mandate. And therefore ONDC may or may not work for us. Now, having said that, if we see a really great deal, great entrepreneur, will we do it? We might. I'm not ruling anything out, but it's less likely.
Got it. Thanks, Sanjeev.
Sanjeev, there's a question in the chat box from Ishan Daga. On startup investment, how is our portfolio companies as a whole performing in the current macroeconomic scenario? Are there any signs of stress or markdown in some of the companies?
I think we've, look, every portfolio will have some situations of stress, and we are no exception. But having said that, I think we're doing fairly all right so far. But tomorrow's another day. We don't know. We are waiting and watching.
No more questions on Q&A.
Yeah, that was the last question we had.
So since there are no more questions, we'll conclude the call on behalf of the company.
Thank you, everyone. Have a great evening.
Thanks, everyone.
Thank you so much.